Okay, we got our income statement here. Sales last year were 100,000, and remember that our forecast was that sales are going to go up by 40%. So if sales go up by 40%, this is a starting point from 100,000, they'll go up to 1,400. Remember, I'm going to put a star here. If this number is wrong, our sales forecast, then the rest of this is not very useful. The more accurate and the more reliable the sales forecast is, the better our pro forma financial statements are. Remember, this already happened. 2011 already happened, and we're forecasting what financial statements are going to look like next year, given this set of 4 simple assumptions. So, sales is going to go up 40%, 1,400. How about cost of goods sold? Well, cost of goods sold, I'm going to put an N here. They're going to go up naturally. That doesn't look like a very good N. There we go. If sales go up by 40%, cost of goods sold is going to go up by 40%. Or another way to think of it is this. Last year, our sales were, our cost of goods sold was what percentage of sales? 700 divided by 1,000 is 70%. Our cost of goods sold was 70% as large as our sales. Our best estimate is that next year's going to be the same. That relationship between sales and cost of goods sold, our markup, if you will, ought to be about the same. So it should be, cost of goods sold should be about 70% of sales, like last year. Cost of goods sold is going to go up naturally. If sales are going to go up 40%, cost of goods sold is going to go up 40%. It's still going to be 70% of sales. So there are 2 ways for you to do this computation if you want to check this. First, let's do this. Let's compute cost of goods sold as a percentage of sales. Is it 70%? That's 980. Another way to do the same thing is say, okay, or cost of goods sold is going to go up the same 40% of sales. That gives you the same 980. Do it both ways and convince yourself, okay, either way is fine. To me, the easiest way for me to do it is to say, hey, the relationship between cost of goods sold and sales is going to remain constant, 70%. So if my sales go up to 1,400, my cost of goods sold is still going to be 70% of that. It's going to go up to 980. Now I do the arithmetic, 1,400 minus 980. My forecasted gross profit, 420. Beautiful. So far, so good. Forecasted depreciation expense. I'm going to draw a big line here because this already happened. This happened already. All right, forecasted depreciation expense. Well, last year it was 30. It was actually 30. Sales are going to go up 40%. My depreciation expense also going to go up 40%. How does that work? No. Depreciation expense is not tied to sales. Depreciation expense is tied to property, plant, and equipment. So, let's look at our property, plant, and equipment. We said that our forecast is property, plant, and equipment is going to go up to 200. So that suggests to me that in this forecasting process, we better look at the forecasted balance sheet now. So here we go. So we're going to stop looking at the forecasted income statement for a minute. We're going to look at the forecasted balance sheet for a minute. So let's be systematic here. Remember, 2000 X1 already happened. We're forecasting 2000 X2. So let's start with cash. We don't need to know cash for exactly what we're doing, but let's do it anyway. If sales go up by 40%, what should our cash do? Well, if we do business the same, if we do 40% more business with 40% more sales, we're going to need 40% more cash in our bank accounts and other things just to handle the 40% increase in the volume of transactions. So it should go up naturally. It should go up by 40% naturally from 10 to 14. A 40% increase over 10. If it's 10, it goes up by 40%, it goes up by 4, and that's now 14. Same thing should happen with other current assets. Think of these as accounts receivable and inventory. If my sales go up by 40%, I'm going to have 40% more credit sales. So my accounts receivable are going to go up by 40%. If my sales go up by 40%, I'm going to sell 40% more inventory. So I need 40% more inventory sitting around for my customers to look at. So my inventory is going to go up by 40%. So my other current assets, my accounts receivable and my inventory should go up by about 40%. 40% of 250 is 100, so 40% increase gets up to 450, and that's just going to, or I'm sorry, 350. That's going to happen just naturally. In a bigger business, it's going to have more cash, it's going to have more accounts receivable, it's going to have more inventory. Property, plant, and equipment. Sales go up by 40%. Property, plant, and equipment going to naturally just go up by 40%? No, I had to make a strategic capital expansion decision, and my property, plant, and equipment net is going to increase by 20. I keep circling this net. After I replace what depreciates, I'm going to increase over and above that. So take a look at this. My property, plant, and equipment net was 300. Some of that's going to depreciate next year. I'm going to replace that, and in addition, I'm going to increase my property, plant, and equipment net by 200. So it's going to go up by 200. It's going to go up to 500. That's going to be my property, plant, and equipment. Next year, I can actually now add up my total assets. Forecasted total assets. 14 plus 350 plus 500 is 864. Forecasted total assets for next year. So in order to do what my plan is for next year, I'm going to need $864 in total assets, which means at the same time, because assets equal liabilities plus equity, which means my liabilities plus equity also have to be 864. Because if I need $864 in assets, I need $864 in financing to buy those assets. And we're going to come back and confirm that that's true in a minute. But for now, property, plant, and equipment is going to be what? 500. So we want to use that to forecast our depreciation expense. So let's take a look here.